There's a man in a 2019 Honda Civic in the parking lot of a Costco in suburban Ohio. He's wearing a jacket he's owned for 8 years. His watch is a Casio. He has a list on his phone and he's going to follow it exactly. He is not interesting to look at. He does not signal anything about his financial situation to anyone around him. He looks, from any external vantage point, like someone who is doing fine, but not exceptionally so. His brokerage account has $2.3 million in it. 3 rows over, someone is climbing out of a leased BMW on a payment that consumes 18% of their monthly take-home. They look considerably more successful. They are considerably less wealthy. And the gap between those two things, between how wealth looks and how wealth works, is exactly what this video is about. My name is William, and the thing I want to show you today is that looking ordinary isn't a personality quirk of certain millionaires. It's a strategy, one with documented financial advantages that compound over decades in ways that the performance of wealth never does. First, what the research actually says about who buys luxury goods. The assumption most people operate under is that visible wealth signals actual wealth, that the person in the designer outfit, the new car, the expensive watch, has the financial foundation to support those choices. The data says otherwise. A study published in the Journal of Consumer Research found that a significant portion of luxury goods purchases in America are made by people in the middle income brackets, not the wealthy, specifically for the purpose of signaling a status they haven't financially secured. Bain & Company's luxury market research found that younger demographics, Gen Z and millennials, are driving luxury sales growth, largely financed through credit. Meanwhile, the actual wealthy, the people with the real numbers, are statistically the least likely to spend on visible status. A Ramsey Solutions study of over 10,000 millionaires found that 61% drove Hondas, Toyotas, or Fords. The median vehicle purchase price was $31,000. Not leased, not financed at length, purchased. The most important finding: 80% of American millionaires are first generation. They didn't inherit the money, they built it. And the behaviors that built it, including deliberate indifference to appearance, are inseparable from the outcome. Looking ordinary isn't what happens after you build wealth. For most people who actually build it, looking ordinary is part of how. The opportunity cost math, what visibility actually costs over time. This is the part of the conversation that turns abstract principles into numbers you can feel. The average new luxury vehicle in America costs approximately $65,000. The average person who buys one finances it over 60 to 72 months at an interest rate that adds thousands to the total cost. Depreciation on a luxury vehicle runs roughly 15 to 25% in the first year alone. By year 3, the car is worth approximately half what was paid for it, while the loan balance tells a different story. Now run an alternative scenario. The same person buys a reliable 3-year-old sedan for $22,000 cash. The $43,000 difference, invested in a broad market index fund at historical average returns, grows to approximately $190,000 over 20 years. Not from a raise, not from a business, from one car decision made once, compounding quietly for 2 decades. This is opportunity cost. Every dollar spent on visible status is a dollar not compounding in your favor. The purchase feels like one transaction. The actual cost is everything that transaction could have become over the time horizon of your financial life. Run this logic across cars, watches, clothing, and a dress, the 4 primary categories of visible wealth performance, and the lifetime differential between the person who signals wealth and the person who builds it reaches into the hundreds of thousands, sometimes beyond. The luxury item depreciates. The alternative investment appreciates. The gap between those two trajectories, sustained over decades, is the entire explanation for why 2 people can earn identical incomes and arrive at 55 in completely different financial realities.
Visibility creates problems that invisibility avoids. There's a practical dimension to looking ordinary that goes beyond investment math. The moment your financial situation becomes visible, through the car, the house, the watch, the address, it changes how people interact with you in ways that are rarely to your advantage. Negotiation is the clearest example. A 2018 study from Columbia Business School found that people perceived as wealthy are offered significantly worse initial terms in negotiation scenarios than people perceived as average income. The logic from the other side of the table is simple. If they can afford the BMW, they can afford the premium. Visible wealth is an invitation to be charged more by vendors, by contractors, by anyone whose pricing has discretionary flexibility. Social dynamics shift in subtler but equally real ways. Money, once visible, attracts requests from family members who need a loan, from friends who assume certain expenses are trivial for you, from acquaintances who price the dinner assuming you'll cover it. The person who looks ordinary navigates those situations without ever having to have the conversation. The person who signals wealth creates the expectation and then has to manage it. Security is a third dimension that rarely gets discussed. Visible wealth makes you a target in ways that are concrete and documented. The person driving the understated car in an unremarkable neighborhood simply does not face the same profile of risk as the person whose driveway signals exactly what might be inside the house. Invisibility is not just financially strategic, it is practically quieter in ways that compound across years of avoided friction. Why conspicuous consumption keeps people financially fragile? The mechanism. The deeper problem with spending on visible status isn't the individual transaction, it's what the pattern does to your financial structure over time. Lifestyle inflation is the technical term. The more visible your financial position becomes, the more expensive it is to maintain the appearance of that position. The luxury car requires the luxury insurance premium. The impressive address requires the impressive mortgage. The designer wardrobe requires seasonal updates to stay current. The signals don't hold their value. They require constant reinvestment just to remain legible as signals. This creates what behavioral economists call a financial fragility trap. High fixed costs built around appearance leave no margin for the events that actually determine financial outcomes: the job loss, the medical event, the market downturn, the opportunity that requires available capital to pursue. The person who looks wealthy but carries the cost structure to maintain that appearance is one bad month from a genuine crisis. The person who looks ordinary and has been quietly redirecting the difference into liquid assets for 15 years has options that the first person simply doesn't have access to. Financial resilience, the ability to absorb shocks and pursue opportunities, is almost entirely invisible from the outside. You cannot see someone's emergency fund. You cannot see their brokerage account balance or the absence of debt on their balance sheet. The things that actually determine financial stability produce no visible signal whatsoever. Which is the point. The things worth having don't show. What this actually looks like in practice, the behaviors, not the theory. Looking ordinary as a financial strategy isn't about deprivation. It's not about refusing to spend or treating frugality as a moral position. The people who do this correctly are not suffering. They are simply indifferent to a specific category of spending that most people treat as mandatory. They buy reliable cars and drive them until the math says otherwise. They live in houses sized for function rather than impression. They wear clothes that are quality without being conspicuous. They don't update things that work simply because something newer exists. What they do spend on tends to be invisible or experiential: health, education, travel that doesn't photograph impressively but feels meaningful, time, the categories that don't signal anything to anyone but produce genuine return in quality of life. The critical distinction is between spending from values and spending from performance. The person spending from values knows exactly what they're buying and why, and the opinion of outside observers is genuinely irrelevant to the decision. The person spending from performance is buying for an audience, and the audience, as it turns out, is not paying as close attention as the spending assumes. Most people dramatically overestimate how much other people are thinking about their financial signals. The person who notices your watch is thinking about your watch for approximately 40 seconds and then thinking about their own. The car you're driving to impress people in traffic will be forgotten before you reach the next light. The performance of wealth costs real money and produces almost nothing in actual return. The man in the Costco parking lot with the 8-year jacket and the 2019 Civic is not confused about what wealth looks like. He is not unaware that he could afford something different. He has simply made the calculation that the appearance of wealth and the reality of wealth are different products available at different prices with different long-term outcomes. He chose the outcome. The financial system rewards the people who build quietly. The compounding works regardless of whether anyone can see it. The emergency fund doesn't need an audience. The index fund doesn't need an audience. Keep the money. Let it work. The only scoreboard that matters is the one nobody else can see. And if you've been watching this channel for any length of time, you already know that's the one worth building.